Hello everybody. So today I want to talk about On Running stock, On Running shoes. ONON is the ticker symbol here. Title of this video is Sales 3x in 5 years, but the stock is flat. Is it too cheap? And my answer to that question is that yes, I think On Running is too cheap. Their mission, I may be paraphrasing here, but I'm done with an 1 hour conference call. I listened to the conference call from a few days ago. I guess it was 2 days ago, 1 day ago even. Anyways, doesn't matter. To become the most premium sportswear brand, and by that they mean worldwide. They think they have a shot at becoming a full-fledged sportswear brand, very high-end, very premium, high gross margin, actually gross margin at about 65% right now for this brand, while the long-term guidance had been 60%. The company is highly innovative. It's growing fast across the world. You have some areas growing in the mid 20%, but you also have some areas of the world, like for example Asia, where this brand is growing at something like 50% year over year. It's getting into apparel. It's getting into lifestyle. It's selling to Gen Z. It's selling to marathon runners. It's selling to speed runners, all sorts of sports. They are developing a brand, and they're developing a reputation for technology as well. And there's a lot of uncertainty about this stock right now. The market got spooked for some reason. Of course, you have the usual, they think there's going to be a recession, and so they sell this type of stock whenever the market thinks there's going to be a recession. But their CEO that they had hired, he had stayed 5 years. He's departing. He telegraphed that pretty well, but the market doesn't like that in general, and you have the founders of the company that are coming back to lead the business as co-CEO, and I think one of the reasons why the stock is slightly down after this quarter is because the marketing expense were a little high, and I saw an analyst who were like, why is the marketing expense a little high? They're talking about how they're investing in the brand, they're doing things for the long term, but then I heard the number of the marketing expense 13% of sales, and I'm like, that's not high at all. Like, give me a break. You have 63% gross margin. You're spending 13% on marketing. That's not high at all if you're building a brand, which, quite frankly, is becoming pretty famous and pretty known, right? If you follow sportswear, I would argue On is the cool shoe of the era. I guess of the past 5 years or something like that. They have highly efficient stores. They have a community who's very committed to them. I think they are well ahead of Nike, for example. They are the cool brand that Nike used to be at one point, but Nike is not that cool brand anymore. Note in my evaluation how I put Nike in there for a comparison. I'll get to that in a second. So as you can see, when they IPO'd, it was $38. They stayed trading, at $38, $35. $40, $45 at some point. They stayed in that range for like 3 months, 5 months. And the stock dumped as was usual during that period, and then it gained momentum right back, and then it dumped again. It halved again. The stock has halved again from mid-2025. That is the story of so many stocks. Hypergrowth stock being punished by the market for, frankly, no reason whatsoever. I mean, you can put so many stocks out of this chart, whether it's HIMS, whether it's SoFi, like so many highly innovative companies have this chart. It makes absolutely no sense, because when you look under the hood, you can see that the revenue growth has been stellar, and it's been unabated, right? They have a little bit of seasonality with the running season, right, in the summer, but otherwise, if you look at 12 months, they've grown. It's been unabated. The growth has been in the 30% for 5 years. Quarter after quarter, you do 30% growth, and they're still doing that, and they're still guiding for that, right? And the analysts are still predicting 28% next 12 months growth, and they have Investor Day in September, so maybe the analysts are waiting for Investor Day to know the next wave of innovation that this stock has. But this company is highly innovative. They talk on the call about their latest innovation, which is Light Spray, which I guess is a robot making a custom shoe for you. And they do tours among their stores, and apparently there's like huge lines, and people are like, not fighting, but not quite, but people are like very excited about their new tech, their new shoe, and of course their cloud technology. I think a lot of people are praising. If you look at all of their rankings, all of the reviews, they have a shoe that people seem to love, an expensive shoe, right? These shoes are $150. And that's why you have 60% margin. Also, sometimes you have a revenue growth and people complain about, shares outstanding. There's no such thing there. I mean, you had the first year that it was public, they issued some shares, but it's normal when a company goes public, when you have an IPO. Then they've even been reducing the amount of shares, right? From 24 to 25, they've reduced the amount of share. And now it's back to being a founder-led business. So I really don't understand why this stock is dumping, except that the market doesn't like growth right now. That's the only reason I can think of. Rule of 40 is achieved at a 48. EV over GP over RG is a 0.15. For, again, perhaps the leading brand in the apparel sector. It's the leading hot growth brand, like the high growth brand that's leading. So I don't get it. I think it's way too cheap. I like the stock at this price. And let me quickly compare it to Nike. You can see Nike is a behemoth, but Nike's gonna drop sales next year. Next 12 months is minus 3%. Only 41% gross margin at Nike. EBITDA margin at Nike only 8%. And if you look, I mean, Nike is trading at 1.5 times revenue. Forward revenue. On Holdings is trading at 2 times revenue for a business that is actually growing by a third every year. That gets a third bigger every year, right? So I cannot understand. In my view, when I do a comparative analysis of ONON, which by the way is a much more lean machine, an efficient machine, compared to Nike, which is an old machine, which doesn't move as fast. Also, ONON talking about how they have to be in like something like 3 times as many stores that they're currently at. They have a huge growth runway getting into more stores. They're definitely not in all of the retailers out there, right? A huge growth runway of ONON Holdings selling online. Their online direct-to-consumer channel also doing very, very well. Nike doesn't really do as well in direct-to-consumer because they have a lot of partnerships with a lot of old world retailers. So in my view, if I were to seek exposure in this sector, ONON Holdings looks very attractive, very appealing right now. And I like this stock. I like this valuation. So anyways, this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.